Hello all.
Hi, everyone.
Got a few people in. Gemma, Clay, welcome. Rebecca, nice to see you here. And Sam. Hope you've all had a good day. We've got a few registered, but they may be running a few minutes late, so we'll just give them a few more minutes to log on.
6:01, got a bit of time.
Hey, Alex. Hope you're well. Hey, guys, you'll see that there's a chat function as well. If you can just maybe just drop us a quick hello. That way we can see you can hear us. Okay. Thanks, Gemma. You can hear us okay? Perfect. Anthony, welcome. Guys, we're just giving a few more minutes for some later arrivals. We'll kick it off in a couple of minutes. So on my last webinar, my first on a buyer's webinar, one of my friends was on and he was like, tell us a couple of jokes while we're waiting. I'm certainly not going to tell any jokes. There might be a few people logging off, but I thought I'd give some fun facts of self-managed super funds and superannuation in general. So there are just over 1.1 million self-managed super funds in Australia. This was about 3 years ago. To your point, Courtney, which you'll probably get in a little bit later, it's not as easy as some people make it out to be. So there, on average, there's 15,000 self-managed super funds, which are wound up every year as well.
Mm-hmm.
I really like this one. The highest portion of self-managed super funds by age group is 60 to 64-year-olds. But this one's the best one, and it's probably very relevant to our group here who's joining us. The highest portion of newly established self-managed super funds by age group is 35 to 44-year-olds, which is probably a lot of people who'll be on today.
Yeah, I think it's a lot of people trying to take control and, not just leave it to the industry fund. So, yeah, that makes sense.
And all of that information was taken from the RSM website. So if any of that is incorrect, feel free to reach out to Courtney.
Fun fact, I better find where you found it.
All right, guys, it's 6:03. We'll kick it off. Obviously, if the people can't make it, we'll send the reporting out to them. So welcome all. Thanks for joining us. Hope you've had a nice day. Not too sure where everyone is, but the weather's pretty rough out here. The windows are getting smashed by rain and wind. So hopefully my internet's all right throughout.
Yep.
Cool. All right. So yeah, welcome once again. So guys, this is a guide into SMSF, self-managed super fund. There's no advice or recommendation being given. We're just going to pretty much just giving an introduction into what a self-managed super fund is. I'm very pleased to be joined by Courtney, who is a self-managed super fund specialist. So all the technical questions can go to her. And me as a mortgage broker, I'm the other side of it. Once you've set up the self-managed super fund, what do you actually do with it? And one of the asset classes is property, and that's where I can get involved.
Mm-hmm.
So I've got a bit of an agenda, but it's going to be pretty fluid. It'd be great to keep if you've got questions throughout, it'd be great to keep it interactive. So you'll see that there's a Q&A section. There's a chat function which you can write any questions throughout. If it's specific to the slide, one of us will read it out at the time.
Mm-hmm.
The rest of them will kind of keep them towards the end, which is the Q&A section. So as a bit of an agenda, so an introduction to your presenters, so Courtney and myself.
Yeah.
And one of the main reasons why we're here, what is a SMSF? Just on that note, I'd love to see if we had a count on how many times SMSF was said today. There'll be a few there. We'll be then talking to as I mentioned, one of the asset classes you can buy within a self-managed super fund is property, and that's where I will come into it. We'll be going through the properties you can and can't buy through a self-managed super fund, and then lending. So this is leveraging the bank's money for the purpose of your self-managed super fund as well. We'll go through the pros and cons, which is huge. And I know Courtney is very passionate about this because it's not suitable for everybody. There is a lot of work upfront and ongoing, but it can be very rewarding at the same time. And then what are the one of the biggest questions, what are the upfront and ongoing costs of setting up a self-managed super fund? As I mentioned, we'll finish off with a bit of a Q&A. But feel free to bring your questions to us throughout on the chat function or the Q&A. I think this probably take about half an hour. We're just going to kind of just touch the surface with what a self-managed super fund is, the pros and cons and lending within it. Anything outside that, we'll be providing you with all of our contact details where you can actually have a one-to-one with us.
Yeah.
So Courtney, I'll pass it over to you. Just a bit of an introduction to yourself.
Yeah, great. So I am a CA SMSF specialist. I work with RSM, and I've been focusing on super for at least the last 10 years, a little bit more, and I just love it. So I'm a bit of a super nerd.
Yeah, and I can see that, and that's one of the reasons why I was like, it'd be great to do a webinar with Courtney on self-managed super funds. I get a lot of questions from people saying, what is it? You know, how can we actually benefit from it? But speaking with Courtney, I can see how passionate she is about it, which you'll kind of see throughout the webinar. Courtney, I'm going to throw you under the bus just to keep it a bit fluid and a bit not informal. Just a fun fact of you.
Oh, fun fact. I once received a highly commended at the Royal Easter Show for cake decorating. So,
oh, wow.
Showing the other side, creative side.
Yeah, nice.
Yeah.
Good stuff.
Yeah, back in the day.
Thanks for that, Courtney. So my name's Raj. I'm a senior mortgage broker at Equilibria Finance, where mortgage brokers who specialize in residential, commercial, and asset finance. Pretty much scattered all across on the East Coast, but our clients are spread throughout the whole of Australia. I'm based on the Central Coast, but like I said, we've got offices in Sydney, Port Macquarie, and Central Coast, and down south as well. I've been doing this for about 18 years now. 18 years at the end of this year, I've been mortgage broking across the UK and Australia. My clients are residential, everyday Australians looking to either build an asset through property or save money on their current interest rate, so keeping the banks accountable as well. And a fun fact of me, I don't know if it's fun or it's weird. There's two things I've never really tried, and one is I've never actually tried peanut butter. I don't know what it is. Whether with my eyes, I'm sure it is, but I've never actually eaten peanut butter or custard. And custard's a cool one because in my school it was very lumpy and thick, and it reminded me of chicken soup. And I was like, I'm not having chicken soup on my cake. There we go.
Oh, very good.
So, guys, I did mention it is all general advice today. We're just going to be touching the surface of what it is. It's an introduction into self-managed super funds. Like I said, if you've got any questions, please keep interactive and send them throughout. But we will be providing our contact details at the end as well. Cool. Courtney, I'll pass it over to you.
All right, perfect. So, firstly, what is an SMSF? It is a self-managed super fund, and it's a type of superannuation fund in Australia that you can manage yourself. Everyone who's been employed has a superannuation fund already. That's where 11.5% of your money goes every month. But say they are industry funds or retail funds like Australian Super or CBUS. So having a self-managed fund is exactly that. You are self-managing your retirement funds. Unlike an industry or retail fund, an SMSF allows you to choose and manage your own investments and insurance. It can have up to 6 members, all of whom are trustees and responsible for the fund's decisions and compliance within the law. It allows money, all the members to pool their money as well and to purchase assets they wouldn't be able to purchase otherwise. So that's sort of a bit of a difference between a self-managed fund and a retail fund. When you want to set up a fund, there are a few different things you need to consider. Firstly, you need to speak to a financial planner. Obviously, I'm not a licensed financial planner. I can help you with any tax outcomes or planning in that way, but I can't tell you whether this is the best investment option for you. So I really do suggest that you do see a financial planner just to make sure that it is right for you and your personal circumstances. Very, very important. And once you get that out of the way, you need to choose a trustee for the fund. So we generally recommend that you have a corporate trustee, which is a company. Otherwise, you can have individuals. So every member of the fund would be a trustee of the fund as well. You come to us, we help deal with the solicitors to get a trustee. The trustee is all the rules of the fund, which must be followed. It sort of sets out everything from start to finish, setting up the fund, what you can invest in, paying out benefits, etc. Then once you've got your trust deed all signed and set up, then we register the fund for ABN, tax file number. Once you've got all that, you go to the bank and you set up the bank account. Once you've got the bank account, it all needs to be in the correct name for the super fund. That's important as well. And then you get an electronic service address. So this ESA is what you give to your employer, and they can then start depositing your superannuation contributions into the fund for you, into the bank account, and it all goes from there. Also, you need to start thinking about preparing an exit strategy for when the fund does eventually wind up. But in the meantime as well, you need an investment strategy of how the fund is going to invest during the term that it's in existence. So there is a lot to setting up a fund. The ATO does have really great resources as well. There's little videos and everything on setting up a fund and what's involved. So really recommend that you can go and check that out, or if you shoot me an email later, I can send you the link. That really does help just move through the steps, because there's a lot of steps. All right, so you've set up the fund and now you're thinking, all right, I decided part of my investment strategy, I want to buy a property. How are you going to buy it? So let's just say you had a lot of money sitting in your retail fund, you and your wife, you've rolled all that money into your retail fund or into your self-managed fund from your retail fund. You might have $300,000 in there. You can make some extra contributions. You found the perfect property. You're going to buy it outright. That's normal. You just, like any other bank, you've got your money, you go pay the deposit from the super fund bank account, and then you pay the settlement from the super fund owns it outright. Where it comes into being a bit more difficult is if you don't have enough cash and you need to borrow. Raj will talk about the ins and outs of the borrowings part of that. But what happens is the super fund is only allowed to have a loan if it's under an LRBA agreement, which is a limited recourse borrowing arrangement. What that basically means is that if the fund defaults on the repayments, the bank can only have access to that asset. So if you had shares and whatever else in your fund, the bank can't take those. It's got limited recourse to be able to take the house or business or whatever the property that you've purchased under that LRBA. There are additional costs involved in going down this road, and different restrictions as well on the properties you can buy. You do need to set up a bare trust arrangement, which does also include having to have another company set up as well to act as trustee for that bare trust. Oh dear. So there are also other restrictions. If you did borrow, you can't see the perfect house down the street and go, oh, I've loved that house. If I could just knock it down and rebuild it, it would be perfect. You can't do that under a limited recourse borrowing arrangement. You need to find the cash to buy that outright. So that's just one example where limited recourse borrowing arrangements don't work for all purchases. So that's definitely something that you do need to consider what type of property you're looking to purchase if you do need to borrow the money. So then if we go onto what type of properties you can purchase, residential. So you can buy a residential property if that's what you think the market's booming in Cairns and you wanted to buy a residential property in Cairns, completely fine. But there are restrictions. You cannot purchase it from a related party. So your uncle's brother, your mum, your sister, you cannot borrow the property from them. Or yourself, if you owned a residential property that you've had, family home, maybe you want to put it in the super fund, you can't do it. And also, once you buy that property, you can't rent it out to a related party. So you can't buy the property in your super fund and let your daughter rent it. That's not allowed. So you do need to buy it from a third party and rent it to a third party.
I have had that question a few times. Sorry, Courtney, to interrupt, but yeah, there's a lot of people who do ask that. Can we buy one and then maybe just use it as a holiday home, or like you said, rent it out to your family member? But yes.
Yeah, so we've had that as well when people buy residential houses and they're doing short-term leases as well, sort of like holiday houses and leases. You can't go and stay in the property. So don't think that just because you're renting it on Airbnb, no one's going to know. You can't do it. So don't risk it. I did hear from an ATO. I was at a super seminar and the ATO have said that they have gone and checked people's Facebook to see if they've been having holidays in their rental properties. So they do fact check. So don't think that you can get away with it and buy a nice little investment property in your super fund that you're just going to have every Christmas at. Don't do it. Not going to work. When it comes to commercial, it is easier. You can buy it from yourself if it's business real property. And then also you can rent it back to yourself if it is business real property. So just say you're a solicitor and there is an office building that you own in your own name. The super fund can buy it off you, and then the business can rent it back from the super fund. So that's definitely a good way to structure having a business within the super fund, or if you've got a business, to have your premises within the super fund and kind of rent it back from yourself. Then also, though, if you are buying it from yourself or renting it to yourself, you do need to make sure that everything is on an arm's length basis. The ATO are really, really strict on that. You'll need to have proper market valuations and everything before you buy it. Obviously, if you buy it from a third party or rent it to a third party, you would assume that it is going to be at market rates. So yeah, you can have commercial, residential. You can have other land parcels and things, but that would be depending on whether you're buying it outright or whether you're having to use the LRBA to purchase the property. So it definitely makes a difference. So don't get your hopes and dreams on what kind of property you've got or you want to buy until you chat with the SMSF specialist just to make sure it's going to fall within the rules. So that's my biggest thing. Just always double check. Don't just assume that you can do it because you read it on the internet. Always double check with a specialist before you go and buy your property.
And buying a property like as just a normal residential, whether it's owner occupied investment compared to a self-managed super fund, it's just from my experience, they're just two complete different things. It's not an impulse purchase. I've seen, like you said, I've seen a property down the road. I'd like to make an offer on. It's not that quick. Like there's a lot of heavy lifting before you get to that stage.
Yeah, definitely. And especially too, if you do need a loan to buy that property, you need to make sure that your bare trust and everything, and you've got the company name and that's set up so you can put that on the contract. So it's really, really important. You don't just go and sign the contract in your own name and think that you can put it in the super fund later. It may not work that way. So you really need to make sure your ducks are in a row.
Yeah, absolutely.
Yeah.
Thank you. So I'll go on to my side. As Courtney said, now you've got the self-managed super fund set up. You want to be looking at how can you actually utilize it. And one of the asset classes that some people do look into is property. So what you then want to do, unless you haven't got the full amount of the fund to purchase the property outright, you can get a loan. So I'll go through a very high level what that looks like. So the types of banks, most of the major banks had pulled out of this type of funding maybe about 4 or 5 years ago. The reason I was told that they pulled out was that it's just too complex for their systems. And I'm pretty sure profit has got something to do with it. Maybe it was just, it just wasn't a profit generator for them. But we're seeing once the majors pulled out, there was just mainly more non-bank and specialist lenders left remaining in that type of space. But now we're seeing more and more, especially these non-bank lenders and the niche lenders coming back into the space. So it's very competitive. And when I'll go through some of the interest rates, you'll see that it's very similar to just normal residential investment rates. To some point, they could even be compared to a residential owner-occupied rate. So we're looking at rates. Now, this is a 70% loan-to-value ratio rate, but 6.99, I guarantee that there's people out there who are paying more than that on their principal place of residence on principal and interest. So the rates, they're not too far off what they were when they originally started this type of lending. Like most residential loans, you can get a 30-year loan term, and like most investment loans, you can get up to a 5-year interest-only term as well, which helps with cash flow. Your loan-to-value ratios, look, I would say typically, ideally, it needs to be around the 80% maximum loan for a couple of reasons: cash flow, interest rate, and then you will have access to more lenders as well. But there are some lenders out there who will go up to 90% as well. The higher your loan-to-value ratio, the higher the fees and all of that. But again, what I do with my clients, similar to Courtney, is sit down, map it all out, and just provide options suitable for them. Commercial, they may be deemed a little bit more risky from the banks or the non-bank lenders and the specialist lenders, so they typically go up to 75% loan-to-value ratio, which is very similar to if you were to buy outside a self-managed super fund as well. And loans, when I started putting this sheet together, I was being probably a bit conservative, just based on my knowledge. It said it has evolved a lot over the last probably 12, 18 months. And I would say like maximum loan would probably be in around the 2 million. And that probably is the case for for some of the lenders, but there are some that will even go up to $5 million, which is a huge. Minimum fund balance is 200. And again, this is probably stepping on Courtney's toes a little bit, but some banks actually don't have a minimum. However, so the rule of thumb would be you ideally need around 250, which allows you to do a transaction and have some kind of liquidity in there at the same time. So I don't know if you wanted to comment on that as well, Courtney.
Yeah, and it's more too also just to make it cost effective. There's the compliance costs are going to be the same every year, whether you've got $200 in the bank or you've got $200,000 in the bank. So it needs to be cost effective. Yep.
Yeah. And I'll show you a quick example of what that liquidity looks like once we've done the purchase as well. Minimum loan amount. Look, again, I kind of was updating some of my knowledge on minimum loan amounts. And again, rule of thumb, it needs to be at least 100K with some of the banks, but there were some banks where I even went down to 10,000 and they still had a loan there. Not that you would, because the cost would just outweigh of having it. So what can you not buy? Very similar to what Courtney mentioned, you cannot buy a owner occupied. This is a pure investment purchase. With most banks, they prefer they won't lend to land only because there's no income coming off that as well, and there's generally no construction allowed within borrowing through a self-managed super fund as well. However, I'll also mention what you can buy. So we know residential property you can buy. In the commercial space, you can buy office space, warehouses, retails. So the list does go on, but it has to be investment and just nothing to do with anything about owner occupied. Borrowing capacity, it's a bit easier than what it would be if it was in your personal name. So basically, what the lenders look at is two things, which could roll into three. But firstly, they look at what the rental income is from that asset that you're buying, along with what are your super contributions. So they would want to see what income you've been paid, along with how much you've actually been contributing to that super as well. Now, one of the things some lenders will allow is additional contributions as well. So if some people are actually making it above the minimum required into their super, they can take that as an income as well. The banks don't look at anything personal. So if you've got a credit card, if you've got a personal a home loan, that's not used as a liability in the servicing for this. So it is a bit more straightforward. Costs, which these are costs for the lender, so nothing to do with the setup of the self-managed super fund. So banks would typically cost somewhere in the region of $1,000 to $2,000. It can be more depending on lenders, but just having a look at what's around at the minute is a very competitive product in the marketplace at the minute. So it's usually setup cost is up to around $2,000 with an annual fee of around $300. Again, that's specific to the lender, nothing to do with the setup and the ongoing maintenance of that self-managed super fund. So I'll go through a bit of a structure. And I think my wife's watching on this. She didn't know her name was going to be appearing on this today. So, and it is something that we're actually looking into personally. So I've just given a kind of an example of what it would look like if you were to set one up. One of the things you can do, you can actually have it doesn't have to be your super on its own. Correct me if I'm wrong, Courtney, you can have up to 6 people.
Yep, 6 members now.
6 members
but that's six people making the decision. So be careful who you choose.
Absolutely. So I would say in most instances, it would be a couple who are looking at buying of setting up a self-managed super fund and then potentially investing in a property within that fund. So I'll give you a bit of an example. So super balances, let's just say mine was 110. My wife works much harder than me, so she's got 140 in hers. We then set up the self-managed super fund. Let's ignore the fees and everything that's going to come out, but let's just say then we now have got a fund of 250k, which we kind of said as a threshold is where you need to be for this to be workable for you. So then the borrower, this is the self-managed super fund itself. So R&T Ladder SMSF Proprietary Limited, with the guarantors being myself and my wife. So we do like property. So we're looking at buying a property up to 500,000. I mean, you can buy a property up to whatever you wanted to, but keeping it easy and simple within the amount of money that we've got, and we want to keep some liquidity in there as well. So we're looking at buying a property up to 500k. Now, our funds to complete, which is most of that will be the deposit, so the 20%, which is 100,000. And then you've got 25,000 worth of fees, which would be predominantly stamp duty. And then you're going to have some other fees of setup costs and so on. So 125k is to set it up. And then we then get an 80% loan, which is 400,000 in this instance. So off the back of that, our liquidity, the remaining funds in there is 125k, but then we're still doing the contributing month in, month out, which is our super contributions, along with the rent that comes into that as well. The rate I had a quick look at some rates earlier today. So 80%, we can get rates of 7.29. Again, in my eyes, that's very competitive for an investment. This is investment interest only self-managed super fund, which I know residential investment interest rates would be around that as well, 7.29. As I mentioned, you can do a 30-year loan term like most everyday loans. In this instance, the repayments, whilst they are on interest only, so will be for 5 years that I've put together, our repayments will be just under 2,500. Now, I want to look at a high yielding property because for me, this is a property which is a set and forget. I want to put it in a property where it gets a good yield, which basically covers the repayment. So in this instance, it would to some degree. Obviously, there's going to be fees, costs, and all of that to come out of there as well. But in the most, it pretty much washes its own face, which is good. And then we won't go into the investment side of things today, but we want to be looking at investing in an area where there is growth and the reasons for growth, low vacancy rates and all of that as well. So you can see based on that property structure, it is workable where you can pretty much have a set and forget facility. And if you've done your due diligence on the actual property itself, it could potentially outweigh what your current super is doing.
Yeah.
Before I go on that, Courtney, I did ask a question to some of the guys on here today. Just has anyone got a self-managed super fund? If so, how it was to be set up? So we've actually got Doug, and he said he's got one, and he actually used a specialist self-managed super fund advisor. Very clever guy, Doug is, by the way. And it can be very daunting, but just having the right professionals, especially in this, which is so complex, is huge.
Yeah, definitely. Because it can go wrong very quickly and it can be very hard to undo, very costly to undo as well. So, all right. So I'll step into the pros and cons. First one, obviously, is flexibility and control. You get to control what you're investing in. You don't have the head of Australian Super making all the investment decisions for you. You're doing it yourself. Tax benefits. So, especially if you've got a commercial property that you're renting back to yourself, obviously you're paying 15% tax in the super fund. You're claiming the rent at your marginal tax rate or company rates. So definitely there's a difference. You're a bit more in control. You might be more likely to make those extra contributions that you can claim as a tax deduction. And also there is a 1/3 discount for CGT once you've held that property for more than 12 months. So effectively that makes the capital gain 10%. So if you're looking at investing in your fund rather than outside, 10% tax on capital gain is pretty attractive. Cost efficiency, it can be more cost effective than a retail fund, depending on your fund balance, depending on your administrator. Some funds just charge a flat rate or a tiered rate based on how much you've got. Super funds aren't always like that, self-managed funds. And then the investment options, obviously, you've got a wider range of investment options, including direct property that we just spoke about. One of the cons, the biggest one people don't understand, is it's time consuming. You are managing this fund yourself. You can't just go, got the money, it's doing it itself. No, every year I'll be ringing you saying, send me in your stuff. You need to make sure that you have it all. You keep your receipts. You do have to go and get market valuations for these properties every year. You need to make sure the leases are up to date all the time. So there is complexity in having a self-managed fund. Costs, again, can be on the flip side. It can be more expensive depending on the complexity of your fund. And responsibility. The trustees are responsible. Whatever decision you make, you are responsible. The ATO will make you liable. If the trustees do make wrong decisions, you can get large fines. So definitely it's not a decision to be taken lightly, but it can be very beneficial if you're willing to put in the time and effort in having a self-managed fund. So once you've decided that it's all good for you, we'll go into the costs, Raj, of setting it up.
Here we go.
Cool. So couple of different fees. So I sort of did the first lot of establishment fees. That's kind of what we're charging at the moment, $2,640. That's for us to reach out. Our deed provider is DBA Lawyers. That will get you the super fund and your corporate trustee. That's all you need to sort of get started. If you are looking at purchasing the property and you need the bare trust and the extra company as well with the super fund and the corporate trustee, that's around $4,190. But we help facilitate all of that for you. We get everything. You just need to sign it all. And as mentioned before, please do get financial advice before you go down this road. That is a cost that could be incurred. Also, if you need financial advice in regards to investment strategies and things like that going forward, that is a fee that is incurred. Ongoing fees, as mentioned before, every year you need to get these funds audited. You need to get them prepared and then they need to be audited. Generally, I would say a super fund with a rental property would start from about $2,000 a year. For accounting fees. Then you would have audit fees, which would, like, they're sort of coming up around the 300, 350, a bit more now, depending on the auditor. Also, every year you need to pay ASIC fees for each company you hold. So if you get a special purpose corporate trustee, that's $65 a year. Any other corporate trustees for the Bear Trust, or if you've got a standard company, that's $321 a year. And then also, when you lodge your tax return, there is an ATO supervisory levy. That's $259. That's added on to each tax return that's lodged. So I did a rough calc before. Minimum on all of those costs was about $2,900 a year. That's just the basic. If you obviously need extra time with your accountant putting together formulations of plans and strategies, could be more. Or if you have really bad record keeping, it's not going to be as cheap. So definitely that's it's something to consider. And also life insurance and stuff as well, you do need to consider as a potential cost in the fund if you are rolling out completely from your retail funds. So that's another consideration to take into account.
Perfect. Hey, Courtney, I'm not across this, but how does that work with the life insurance? And do you then, can you get it within the self-managed super fund?
Yeah, so you can. So life insurance policies are deductible when they're held within the super fund. So obviously that offsets any income that you're getting. And yeah, but that just means when you do pass away, your super fund gets your death benefit. And then it can be paid through from there as a death benefit pension or a lump sum payment to your beneficiaries. So it is definitely something that you need to consider because most retail funds will have life insurance built in. Yep. And you just pay for it, you don't even know it. So we do say, if you close your retail funds, be very mindful that you don't have life insurance unless you go down this way. Or sometimes some clients will even leave a small amount in their retail funds just to keep that life insurance policy going. So that's another option as well.
Perfect. Good stuff. All right. So guys, we did say we're going to keep it quite light. So hopefully that's covered it off. So over to the Q&A. We do have a question from Matthew. Here's one for you, Courtney. So how much do I need before it's better than a public fund?
So I think we touched on a little bit before. I do think a super fund needs to have at least $250,000 just to make it, to make it cost benefit wise. Otherwise, you're paying a lot. And yes, some of the compliance costs you can't get away from. As I said, no matter how big or small your fund is, you can't get it done any cheaper. So yeah.
Hopefully that's answered your question, Matthew. So yeah, it looks, we haven't got any. Is there any more questions while you're at it? And while we're at it, I've just put our contact details, so our direct contact numbers and email addresses. We will be sending the recording out along with all of our contacts with a feedback form as well. It'd be great just to get a bit of feedback, what your thoughts were, any improvements for our further ongoing webinars. But if there's no further questions, maybe we can wrap it up at 6:40, which is pretty much on spot what we said. Matthew's got one coming through by the looks of it. Hey, Doug, if you're still around, it'd be interesting. How was your process of putting it together? Was it pretty difficult to get through, or obviously with the help of your self-managed super fund made it a little bit easier? We've got another question from Rebecca. I am in a APS defined fund, so would it be better to keep that open?
Yeah, so defined benefit funds, they are a different kettle of fish. So you do need to seek financial advice when it comes to those kind of funds. So that would be something that you would need to speak to your tax accountant about, a specialist. Yeah.
Perfect. Hopefully that answers your question, Rebecca. And like I said, you've got our contact details here. We will reach out to you guys with the copy of the recording as well, along with our contact details. And thanks, Courtney. Thank you for joining.
No worries. Thanks for having me, Raj.
It's great to have you on. And thanks, guys, for being here. Hope you've learned something. Hope you take something away. If you've got any questions, we look forward to hearing. evening.
No worries. Thank you. Thanks, guys.
Bye.
See ya.